You know, um, imagine you're playing a massively multiplayer online role-playing game. You've been in it for years, just grinding away, memorizing all the rules the developers handed you.
Right, gathering the resources, staying on the prescribed path.
Exactly. You try to level up your character, but the longer you play, the more you realize the in-game economy is, well, it's mathematically rigged.
You can never actually win.
Yeah, you can only sustain your current level. Then one day, you lean against a random digital wall in the game, and you just fall right through it. You discover a glitch in the architecture.
You suddenly realize the boundaries that seem so absolute, the walls dictating where you could and couldn't go, were just lines of code.
Right.
They aren't laws of physics.
And today, we're exploring a massive structural glitch in the real world. Welcome to the deep dive.
It's great to be here.
We have this really fascinating stack of notes and analytical excerpts today from a framework called Breaking the Time for Money Trap, the Jules 9000 blueprint.
Yeah, this is a heavy one.
It really is. Our mission for you today is to pull apart the architecture of the modern economy and explore why the traditional 9-to-5 job isn't actually broken. I mean, it's functioning perfectly, but it's functioning by a design that makes the architect wealthy, not the worker.
What's fascinating here is that the Jules 9000 blueprint doesn't approach this from a place of, philosophical grievance.
And not just complaining.
No, not at all. It doesn't waste time demonizing hard work or corporate structures. Instead, it conducts this rigorous, almost clinical mathematical audit of how W-2 income actually functions over a human lifespan.
Which is something we rarely look at so objectively.
Exactly. We are simply looking at the structural mechanics of a system we've been trained since kindergarten to accept as the absolute default.
Okay, let's unpack this by looking at the geometry of that default system. Because the blueprint isolates the problem down to the core mechanism of active income.
The time for money exchange.
Right. We all know the basic definition. You trade an hour, you get paid for an hour. But the Jules notes highlight the hidden mathematical ceiling built into that transaction. And I was thinking about it kind of like an hourglass.
Oh, I like that analogy.
Yeah, so imagine your career as an hourglass. The sand inside is your hourly rate. Maybe you have a standard job, so it's regular sand. Maybe you're, I don't know, a highly specialized neurosurgeon or a corporate lawyer. And your sand is literal gold dust.
It's incredibly valuable per grain.
Exactly. But the value of the sand ultimately doesn't change the physics of the glass.
No, it doesn't. The neck of the hourglass, the mechanism that actually lets the sand flow, is your time.
Right, the aperture is totally fixed.
Yeah, it doesn't matter if you command $500 an hour. You are hard capped by the biological reality of a 24-hour day.
You inevitably run out of sand to pour. And there's this deeply poignant story in the source material from an offshore oil rig worker.
Oh yeah, that part was tough to read.
It really was. They were operating at the absolute peak of active income potential, right? Making incredible money. But their analysis of their own life was just brutal.
They noted that they were generating massive cash flow, but they were entirely bankrupt in time.
Bankrupt in time. I mean, they missed their kids growing up, they missed their own life, because the only way to keep the gold sand flowing was to physically stand next to the hourglass, day in and day out.
They were liquidating the most finite, unrecoverable asset a human possesses, right? Their biological time. And they were exchanging it for a highly inflationary fiat currency.
It's kind of tragic when you put it like that.
It is, because when you look at the math, a 1-to-1 input-to-output ratio is just the least efficient economic model in existence. It has zero scalability.
If you stop moving, the entire economic engine of your life just seizes up immediately. But wait, let's play devil's advocate for a second, because a lot of people listening might be thinking, well, if my sand is incredibly valuable, let's stick with the neurosurgeon or, the high-earning tech worker making $300,000 a year.
The high earners.
Right. The quote-unquote safe route our parents sold us says that person just needs to max out their 401k, aggressively funnel that high active income into index funds or savings, and the math will eventually work out.
The idea that they can essentially save their way to the escape hatch.
Exactly. Doesn't that work?
Well, that assumes the environment around the hourglass is completely neutral.
Which it isn't.
Far from it. The Julich blueprint meticulously deconstructs why that environment is actually deeply hostile to wage earners. If you rely purely on active income, you are running headfirst into two systemic buzzsaws.
The structural reality of the rat race and inflation.
Yes. The silent confiscation of wealth through monetary dilution or inflation. And we really need to look at how these mechanisms specifically target the W-2 worker.
Let's talk about the dilution piece then, because we all know inflation means prices go up, milk costs more. But the GLE's notes frame it entirely differently. They frame it as a targeted wealth transfer.
Right. When we talk about inflation, we aren't just talking about a gallon of milk costing 80 cents more. We're talking about the expansion of the money supply, fundamentally devaluing the currency you are currently holding.
So your savings are literally shrinking in
Mhm.
purchasing power.
Exactly. If you are trading your finite time for dollars and then just sitting those dollars in a bank account, you are storing your life energy in a leaking battery.
Wow. A leaking battery.
Yeah. The W-2 worker negotiates their salary in yesterday's dollars, receives it in today's dollars, and then has to buy groceries and housing in tomorrow's dollars.
Because wages never rise as fast as prices.
Never. Wage stickiness guarantees that your active income will almost always lag behind the real rate of monetary expansion.
So while you're busy pouring your sand, the room around the hourglass is basically on fire, burning the sand at the bottom of the glass.
That is exactly what's happening.
And if you take that a step further into the rat race concept,
Mhm.
I mean, the blueprint defines the rat race not just as like lifestyle creep by nicer cars,
Yeah.
but as a structural tax trap.
Oh, absolutely. W-2 active income is the most aggressively taxed revenue stream on the planet.
Period.
Period. As you work harder and grind for that promotion, pushing yourself into a higher bracket, a massive percentage of your additional effort goes straight to the state.
You are running exponentially faster on the wheel just to maintain your current purchasing power.
And the system relies on that exact illusion of progress. Your nominal income goes up, so it feels like a victory.
You're going to raise.
Right. But your real purchasing power, after taxes and true inflation, remains stagnant or actively degrades.
Which is mind-blowing.
A standard salary, when you analyze corporate financial models, is calculated to be the precise equilibrium point.
Meaning just enough to keep you coming back.
Exactly. Just enough capital to ensure the worker can house themselves, feed themselves, and return to the factory floor or the Zoom screen on Monday morning. But never enough capital to allow them to permanently opt out of the labor pool.
Because if they could opt out, the company loses its leverage.
Precisely. Your surplus productivity is systematically channeled upward to create leverage for the equity holders.
Okay, so if the conventional architecture, high wage, active income, combined with aggressive saving is mathematically flawed due to inflation and tax structures,
Yeah.
what is the alternative architecture?
Right, because someone is winning this game.
Exactly. The people at the absolute top of the economic pyramid certainly aren't clocking in for an hourly wage, and they aren't worried about milk prices. So what are they doing?
This raises an important question. What is the actual mechanism of wealth creation? If it isn't time for money, what is it? The blueprint isolates the singular tool of the wealthy as leveraged income.
Leveraged income,
Yeah.
which is different from passive income, right?
Yes, we really need to distinguish this from pure passive income. Passive income often requires massive upfront capital, like, buying a $3 million apartment complex to live off the rent.
Which most people just do not have.
Right. Leveraged income is different. It is the ability to decouple your output from your input. It is the ability to put in 1 unit of effort and generate 1,000 units of return.
Okay, so we aren't talking about the old cliche physics analogy of using a long lever to move a heavy boulder. In the modern context, we are talking about digital cloning.
That is a far more accurate model, digital cloning. The wealthy build or acquire systems that operate completely asynchronously from their biological bodies.
Okay, give me an example.
Sure. Think of a software developer. They write a piece of code over the course of 6 months. That is a finite investment of active time.
Right, 6 months of standing at the hourglass.
Exactly. But once the code is compiled and hosted, it can be duplicated and sold to 100 million users across the globe simultaneously, 24 hours a day at near zero marginal cost. The developer's earning potential is entirely unmoored from the ticking of the clock.
They bypassed the neck of the hourglass completely by just shattering the glass. They built a machine that manufactures sand while they sleep.
That's it. And this applies to capital leverage, too. They use other people's money to acquire assets, or they use media leverage, like recording an audio track or publishing a video that reaches millions of people while the creator is out walking their dog.
The work is doing the work for them.
Right. The financial habits of the ultra-wealthy are ruthlessly focused on acquiring digital, capital, or labor leverage. If a task requires their continuous physical presence to generate revenue, they will automate it, delegate it, or abandon it entirely.
Okay, let's bring this down to earth for a minute. Hearing about a tech billionaire writing scalable code, or a private equity firm using capital leverage sounds great in theory.
But it feels out of reach.
Yeah, exactly. The Jules 9000 blueprint claims this isn't just for the ultra-rich. So how does the listener, someone who might be, commuting to a mid-level corporate job right now, who has a mortgage and a family, actually capture this digital real estate without having venture capital or knowing how to code Python?
The democratization of digital leverage is really the core thesis of the blueprint's second half.
Because it's changed so much recently.
Dramatically. 20 years ago, gaining media or distribution leverage required owning a printing press or a television network. Today, the infrastructure is completely free and globally accessible.
We all have phones.
Right. Ordinary people can construct highly leveraged income streams outside of their 9 to 5. And one of the primary low-barrier mechanisms the text dissects is affiliate marketing.
Which, to be clear, often gets a bad rap. I mean, people hear that and think of some sort of late-night infomercial hustle.
Absolutely, it has a stigma.
But the blueprint breaks down the actual back-end mechanics of it, and it's a brilliant study in risk asymmetry. I mean, you don't have to manufacture a product. You don't have to hold inventory in a warehouse.
You don't manage supply chains. You don't deal with customer service refunds.
Right.
You are outsourcing all the heavy, capital-intensive infrastructure to established corporations. Because think about it. Companies have highly developed products, but their biggest bottleneck is customer acquisition cost.
Finding the buyers is the hardest part.
Always. Traditional advertising is expensive and inefficient, so they deploy a commission model. They provide an individual with a unique tracking link, often embedded with a digital cookie.
So you become the connector.
Exactly. Your sole function in the economic chain is to build a digital bridge between a high-intent consumer and the product they are already looking for.
Okay, let's drill into that digital bridge concept, because that's where the leverage actually lives.
Yeah.
Say you write a highly detailed, deeply researched guide comparing the top 5 solar generators for off-grid camping.
Perfect example.
You spend an entire weekend writing the guide, formatting it, and optimizing it for search engines. You embed your affiliate tracking links. You publish it to a blog. Now, that was active work, right?
Yes, that was trading time for the initial asset creation.
But then the mechanism of the search engine turns it into an unpaid employee.
The search engine indexes the article, and then, 3 years later, someone types best off-grid solar generator into their phone at 2 in the morning.
While you're asleep.
While you're asleep. They read your article, click the link, the tracking cookie fires, and registers your ID with the manufacturer. The person buys a $2,000 generator, and you wake up with a $200 commission in your dashboard.
That is incredible.
You performed the labor 3 years ago, but the digital clone of your effort is still actively working the sales floor.
But hold on, let me push back on this on behalf of the listener. You are building this highly leveraged bridge, sure, but you are building it on rented land.
Ah, algorithmic dependence.
Yes. Whether it's a search engine, a video platform, or a social media feed, you are entirely dependent on their algorithms. A developer pushes an update in Silicon Valley, the algorithm shifts, your article drops from page 1 to page 50, and your income goes to 0 overnight.
It happens all the time.
Right. Haven't you just traded a human W-2 boss for an algorithmic dictator? I mean, how is that actually freedom?
That is the most critical vulnerability in the digital leverage model, and it's something the blueprint addresses directly. If your entire system relies on a single traffic source, say, one social media platform's algorithm, you don't own a business.
Yeah.
You own a highly volatile digital lottery ticket.
A lottery ticket. So how do you fix it?
True leverage requires building a moat. The sophisticated operators use the algorithm to capture attention, but they immediately migrate that attention to assets they own outright.
Like an email list or a direct newsletter?
Precisely. You use the search engine to get them in the door, but the real value is capturing their direct contact information. Once a consumer is on your email list, no algorithm can prevent you from reaching them.
You own the distribution.
You establish a direct, unmediated communication line. Furthermore, the blueprint emphasizes aggressive diversification. You don't just write a blog. You syndicate the content into video, into audio, into social micro content.
They're everywhere.
You weave a web so dense that the collapse of any one algorithmic update doesn't threaten the structural integrity of the whole system.
You are systematically turning a volatile traffic stream into a hardened digital asset. You know, there's a quote from the source material that sums up the psychology behind this perfectly.
Oh, the one about getting free.
Yes. A practitioner noted, I started building this digital infrastructure on the side. Not to get rich quick, but to get free. It strips away all the toxic hustle culture rhetoric.
It's not about buying a luxury sports car next month.
Exactly. It is a slow, methodical engineering project. You are constructing an escape hatch out of the maze.
Which requires an entirely different psychological relationship with your current situation. Because the goal isn't to impulsively burn your life down to chase a dream.
Right. And here's where it gets really interesting. The Jules 9000 notes explicitly tell you not to demonize your 9-to-5 job.
The job isn't the enemy.
No. It's a tool that you are currently misusing. You can actually flip the dynamic. Instead of your employer using your time to build their leverage, you use their stability to fund yours.
That is such a crucial mindset shift.
It is. Your W-2 salary becomes the venture capital for your digital operations. It pays the domain hosting fees. It funds the software subscriptions. It covers your mortgage while you spend your weekends writing those solar generator articles.
You aren't trapped by the job. You are actively utilizing it to finance your own obsolescence as a laborer.
Finance your own obsolescence. I love that.
That cognitive flip is the turning point in the blueprint. You transition from seeing yourself as an employee enduring a grind to viewing yourself as a startup founder whose current primary client just happens to be your 9-to-5 employer.
You are playing an entirely different game on the exact same board. So we've broken down the geometry of the trap. We've looked at how inflation and tax brackets punish linear income. We've explored the mechanics of digital leverage, tracking cookies, and building algorithmic moats.
We've covered a lot of ground.
We have, but we have to look at the ultimate destination. If you successfully build these digital bridges and you insulate them with owned audiences, what is the actual prize at the end of this blueprint?
Right. What is the point of all this?
Yeah, what does financial freedom tangibly look like when you strip away the internet marketing hype?
Well, financial freedom, in its purest mathematical form, is remarkably mundane. It simply means the yield generated by your leveraged digital assets and passive investments crosses the threshold of your monthly burn rate.
So it's just a math equation.
That's all it is.
Yeah.
If it costs you $4,000 a month to live, and your digital infrastructure consistently yields $4,001 a month without your daily intervention, you are financially free.
Period.
Period. Your biological presence is no longer mandatory for your economic survival.
Because the core philosophical undercurrent running through every single page of the Jules S9000 material is that freedom has very little to do with currency. Wealth is not a number in a bank account.
Yeah.
Wealth is ultimate sovereignty over your own time.
Currency is just the crude, highly flawed instrument we use to navigate the logistics of the modern world. Time is the actual substance of existence.
That brings us full circle, right back to the offshore worker who was drowning in cash but bankrupt in life.
They had the equation completely inverted.
Completely.
Yeah.
The entire thrust of this blueprint is the realization that a Tuesday morning spent doing exactly what you want with the people you want is fundamentally, universally worth more than any corporate salary increment.
If we connect this to the bigger picture, it changes how you evaluate risk.
Right.
People look at building a side business or creating digital leverage as risky.
Oh, all the time. Don't quit your day job.
Yeah. Right. But the blueprint argues that the ultimate catastrophic risk is spending 35 years of your finite existence executing someone else's business plan, only to realize at the end that you traded the best years of your life for a currency that was intentionally designed to lose its value.
Wow. So what does this all mean for you listening right now? It means the fundamental question you have to ask yourself when you look in the mirror tomorrow morning isn't, how can I optimize my W-2 workflow? Or how can I squeeze 3 more billable hours out of my exhaustion?
No, the question is, what digital architecture am I building today that will pay me a dividend of time 5 years from now?
It's the shift from being a cog within a system to becoming the architect of your own ecosystem.
The glitch in the video game is fully visible now. You understand the math of the trap and you understand the mechanics of the lever.
And once you see that the walls aren't solid, it is virtually impossible to unsee it.
You can't go back.
You realize you don't have to stay in the maze just because the walls are painted with motivational corporate slogans. The tools to build your digital clones, to capture your own digital real estate, are literally sitting in your pocket right now.
It's all right there.
As the JLES 9000 intro wraps up, it leaves the reader with a clear mandate. Stay curious, stay free, stay galactic. The escape hatch doesn't build itself, but the schematics are available.
The infrastructure is waiting. It simply requires the execution.
And as we close out today's deep dive, I want to leave you with one final thought to mull over, building on this undeniable reality that your freedom equals your time.
Yeah.
If your biological time is the only truly finite resource you possess, then every non-essential purchase you make isn't actually paid for with fiat currency. It is paid for with the unrecoverable hours of your life it took to earn that currency.
The math is relentless.
It really is. So the next time you tap your card for something you don't truly need, stop and ask yourself, exactly how much of my actual irreplaceable freedom did this just cost me?
That framing completely alters your relationship with consumption.
It changes everything. Because remember, we all start out playing by the rules of an economic game we didn't write. But once you find that glitch in the wall, you never have to play the game the same way again. Thanks for joining us on this deep dive. We'll see you next time.